Joe, what should a regular investor be doing now? What's some standard advice?
Right. Well, I think that the basic is to understand that the markets are volatile, that the game that we're all in is one of ups and downs, historically ups and downs, but over the long term, generally up. But that to play that game, one has to be in the game. So many have heard that trying to play market timing just doesn't work. When you try to time the market, knowing when to be in, when to be out, you have to be right twice, basically. You got to be right when you get out. You got to know that you're getting out before it goes down further, and you got to know that you're getting back in before it's gone up too much. So one of the investment managers that we use has done some studies and looked at the period from 1995 to 2005, which is obviously a very volatile period of time, included those 3 years that I talked about before in the early 2000s, and looked at an investor who stayed in, who hung with it from the beginning of 95 through the end of 2005, including all those volatile periods of time. That investor, based on the measures that they used, would have had a return that was about 11%, a little bit less than 11%. For the investor who thought they were smart enough or just pure scared and got out of the market and missed only the best 10 days of that market, so not a whole long period of time, missed those best 10 days, their return would have been a little less than 7%, about 6.5%. So 11 versus 6.5, and then if you take out more periods of time where they would be out of the market, which is probably likely, it hurts the return even more. So the message is, again, based on as best as we can know, given what's happened in the past, staying in the market makes the most sense. The most important thing, though, is how one stays in the market. So it's not just making guesses, it's not pretending it's Las Vegas, it's having a well-diversified set of investments. So that's different companies, different issuers of debt, but also then diversification across broad asset classes. So not making bets on oil or gold or any one particular sector, but having exposure to U.S. companies that are large and small, that are growth-oriented, that are value-oriented, having exposure to international companies that are both in developed markets as well as developing markets, or what people call emerging markets, and then having a panoply of bond investments that are both U.S. as well as foreign bond investments, all based on what one's overall risk tolerance is, so in terms of the mix between stocks and bonds and real estate. So getting that in place, having it make sense, not make bets on discrete parts of the market, and then rebalancing over time as things go up and down. So sell what's gone up a lot and buy what's on sale, what's gone down a lot, to keep within that balance that matches your asset allocation and your risk tolerance. Doesn't guarantee at all that things won't go down, but it should give you some measure of sleep at night factor to know that you're doing the best you can do. The alternative would be put the money in the mattress, and we know that taxes, inflation, future market performance will make that the wrong choice.
Some great advice, and we'll be checking in with you in a few weeks to see if there have been some new developments. Great. You can also check out Joe's column, which will be running in our newspaper starting in a few weeks. I'm Caryn McBride. Thanks for tuning in.